Well, I think it does make sense. I do think it's a little bit of a reaction to the extent that we still have inflation issues. We still have a strong labor market. Wage inflation is still present. It's above where the Fed wants it. But look, Sarah, I think the key message here today is that Fed policy doesn't have to drive the U.S. economy over a cliff in order to get inflation under control. So it does suggest that whether it's 5% or 5.25% or maybe even 4.75% could be the terminal policy rate. This certainly gives people in the bond markets a little bit more assurity. And, we've been saying for a long time bond yields are high and it's attractive. But the one fly in the ointment has been that yields keep going up. And, maybe if inflation is peaking, this may mean that yields may not continue to go up perpetually. So therefore, the value becomes a little bit more apparent.
So what is the move here? Would you buy bonds? You think we can go farther?
So I do think that scaling into fixed income right now is the right thing to do. We've been saying that for the past month or so. So it's essentially what we would argue is that you want to have roughly a 3-year duration. And we would get there by owning some long dated bonds, so some around the 10-year point and some at the very, very front end. The front end is somewhat attractive these days, given that, we think the Fed policy rates are going to stop, somewhere closer to 4.7 to 5%. And I think that credit also becomes attractive. So the all-in yield for investment grade credit was up above 5.5%, 6%, some even higher than 6%. That's pretty attractive when you're moving into an environment where inflation may be slowing and we may even have a mild recession.
Yeah. But don't you think the Fed is going to be very careful, Jim, with how the language it uses in terms of switching to be very dovish very quickly? They've been wrong. They were wrong and late on inflation. I feel like they're going to be pretty cautious in suggesting that we've seen the peak or that they're going to do less. Is that going to rattle markets, or can the market look past that?
Sarah, that's a great point, and that's why I'm not pounding my fist on the table and saying this is just an easy buy at this point. The Fed has been wrong before. Inflation is surprised to the upside. We still have a strong labor market. If the Fed has inflation on the run and their prescription is still to put policy rates 4.75% terminal or 5% terminal or maybe even higher than that, then that's going to weigh on fixed income markets. So like anything else, I think timing your entry points and being slow in building that position in fixed income makes some sense. And when bond yields are at 4.25% in the 10-year or 4.2, it sounded a little crazy because, well, yields kept going higher and people thought they were going to 4.5. But the point here is that I think that the 4 to 4.25% area in bonds represent value at this current juncture. Maybe we'll get a backup. Maybe we'll get another piece of data that does that. But this is, it's an opportunity to really start building positions in fixed income, which I think people have been underweight, unfortunately, for right now, because I think there is a pretty good opportunity going into 2023.